Hey everybody, welcome back to the channel. This is Troy's Winding Down Chronicles. In this video, I'm going to be breaking down my 2025 investment results, what performed well, what didn't perform well, and the lessons I learned I will leave for the end. And this will be for the entire year of 2025 and the year before I came into early retirement. So I originally thought I needed to do this video within the first week of January. I was rushing myself, and I'm like, why? That was ridiculous. So most companies only are start reporting their returns and their reports from the last quarter around this time anyway for the next couple weeks. So I'm going to treat this like I'm my own business. And I'm going to be reporting on how well I did and didn't do, and I hope you enjoy to see how I talk through these results. I do review my investments every year, but not to the detail that I did on this past year, because now I do have time and I find a lot of interest in this. So again, this isn't advice. I'm not flexing numbers because you will see I did pretty well. Especially compared to S&P 500. These are real results, real decisions, and real life lessons as I transition into living off my investments. It's going to become evident. I'm not showing the 2024 figures of the last 2 years have been stellar in the market, especially coming off of the scary 2022 year when I took a lot of losses and made many mistakes. 2020 through 20, I'm still making mistakes, but 2020 through 2022, oh my gosh, it was awful. 2021, okay, but then reality hit me, as it probably did most people, even veteran investors. From what I hear, 2022 was just an awful hit, and especially if you never experienced something like that. I lost sleep sometimes. But fortunately, most of those gains were recovered since then. But if you didn't make money in the last 2 years, I'm not sure what you're doing. Either you aren't in the market or interested, or you're listening to Cathie Wood. And if you don't know who she is, look her up. She's a big fund manager that gets a lot of spotlight because she was kind of a one-hit wonder with Tesla. She got into Tesla early, but ever since then, her performance doesn't make sense over the past 2 years. Anyway, ARK, check out her ARK funds if you're interested. She's lost money, so I don't understand what she's doing. And I'm an idiot, and I made money. So I'm doing this short video, this series of all my finances, because I think, one, I do this anyway for my own personal self. And I've been working in finance with NGOs for the past 30 years. So it is nature to me to be doing this, not specifically personal finance, but reporting on finance to the boards and to donors and other constituents who are interested in what the organization is doing. I think many people are curious about how others do. Which is why I'm sharing. Even though we're not supposed to measure and compare ourselves, we do it anyway. I like to watch other people. I'm very happy to see when other people do well and are transparent. There's a couple guys out there that I really appreciate hearing what they've done over the years, and I just want to be part of that. I think it's fun and it's interesting. But remember, you do you, I do me. I like to know what people are doing, most importantly, and how they're doing it, and even more importantly, what the lessons they've learned. So I'm hoping maybe this helps someone, and if it does, please leave a comment. I'd love to hear from you in the comments below. So I believe in these quotes, what gets measured gets managed, what gets managed improves. So I think if you're not doing this to some degree, you have no idea where you came from. And then, for me, it's relatively simple in a way. I keep my spreadsheets and I use my Quicken to help me also manage basically as a database. So just a quick intro into where my investments are now. 2025, my life changed drastically because I learned by mid-year that I would be facing early retirement. Even though my goal was to be doing early retiring around 55, 56, 57, this became the reality. Our Doge made funding cuts, and that was the domino effect to get me where I'm at now. I cut myself from my work, one, because I didn't like where I was working, and two, it was like I only really had, I would have had 6 months left on my contract anyway, and I didn't want anyone from my organization to lose their job. So I cut myself to save their jobs. On top of it, I don't have $1 million. So of course the golden target is $1 million, but I don't have that. And I would have liked to have had that. It would have made me feel a little better. So that just makes things maybe a little more interesting to follow me and see how I track. So I'm entering into early retirement on a modest budget, so I'm gonna have to be careful. I don't have a lot of money. I don't have that perpetual money loop, as we sometimes I hear people say, where I just live off of my interest or live off of my dividends. I don't have enough for that, so it would be nice, but c'est la vie. I have what I have, and that's what I'm going to manage. So my investment strategy at the beginning of 2025, I was an 8 out of 10 risk level. So that means I'm relatively high on the beta scale of I'm okay with market volatility. The market goes up and down. And people who are not okay with market volatility, like my mother was, she had 0 risk tolerance, and she would have been like a 1 out of 10. And basically she would have been just okay with earning interest from a bond. I mean, I think that was pretty much all she was invested in, bonds and interest from savings accounts. And where I am, it's kind of ironic that I am 8 out of 10. I will take risk if I know the payoff could be potentially there, because you're not going to get rich by not taking risks. And not that I wanted risk, I just wanted more options. That changed things for me in the beginning of 2025. I had to start moving my thinking about changing my portfolio from an 8 out of 10 to possibly a 5 to 6 out of 10. So, but that's going to take some time, because I don't want to move too much money too fast last year, because I don't want to pay the taxes on them. I'd rather wait until 2026. But that's part of my plan, and that's what I'm developing now. I'm late in the game. I mean, by now, some say that 5 years out, you should be de-risking greatly, because you don't want to go into some type of recession or something right when you start, because I am vulnerable to frequency of returns risk. That's where you go. That's where you enter the market in early retirement when the market's going a downhill. So I didn't want to do that, and but I don't have any really choice now. So I'm going to be I started relatively aggressively changing my blueprint mid-year last year, and you'll hear a little bit of that next. And again, basically, I'm fast tracking my de-risk to protect my capital as I head into early retirement. The part of the reason I wasn't so anxious to move too fast was because I knew my severance and my final pay should be enough to cover at least a year of expenses, up to a year of expenses in early retirement. So I have the rest of this year to be a little more aggressive with money. So I'm going to be giving percentages. This is not financial advice. Don't listen to me. I'm an idiot. I'm only sharing my experience. This is for entertainment only, and I think the most important part is the lessons I've learned in the year. And I'll show some snapshots of some actual percentages of some of the gains I made in actual positions, just to give you an idea of what kind of gains were made. And I only do this to show you what's possible, because some of them actually still shock me as well. If I would have known 15 years ago what was possible, even 20 years ago, 15, 20 years ago, I would be in a much better financial position than I am now. You can't cry over spilled milk. So I mentioned my blueprint. So my blueprint is basically my investment plan. It might be a little more complicated than most people's because I do have a portfolio of stocks. I am 100% equities, so 100% stocks. I don't have bonds, and I just have some cash, other than a couple small assets aside from my house. So my general blueprint. So I have four accounts: a Roth account, an IRA account, a brokerage account, and a speculative account. My ratios are currently ETFs and income stocks. I lump them together. Currently, they're at 23% of my overall blueprint, my overall portfolio, but I want to try and get that to 50%. I have dividend growth stocks. These are basically dividend payers, but very small dividends. I'm not in it for the dividend. I'm in it more for the growth. The dividend is a little more of a cherry on top, something like Microsoft. The dividend growth stocks are at 25% currently, and I'd like to increase them to 35%. My growth stocks, which don't pay a dividend, and they comprise of mature stocks like Amazon. So the growth stocks consist of mature growth, hyper growth, and normal growth. So right now they're at 42% of my portfolio, but I want to reduce that down to 30 because they are a little more volatile. And then I have the speculative. So currently my spec stocks are basically the ones who are kind of moonshots. It's all or nothing. You could lose your whole investment, or you could 10x your investment very quickly. 11% of my portfolio is in speculative, and by the end of the year, I probably want this to around 5 to 10%. But I do want to keep that for the growth, and I do like to follow potential bangers, 10xers, 20xers. You'll see I've got a couple 20xers that are just, they just make a huge difference. They can go from your portfolio, with a $1,000 investment to being like at the end of your performance, a little bit of money into these stocks can make a huge difference on where they position themselves later in your portfolio if they do well. Some rules: I am not a trader. I'm not a day trader, although I might sell out a stock later if it does, within a couple months or a couple years, I might sell a stock. I look for opportunities to present themselves. I am a buy and hold investor. I will hold for 3 to 5 years, and if the stock performs well sooner than the 3 to 5 year plan, then I might start selling some of the stocks to keep the gains and reinvest those elsewhere in the other opportunities. And sometimes I might sell the entire position if I don't want to hold it anymore. So most times I sell to cover my cost basis, and let the rest of the stocks ride. This concept is called holding house shares. I do have positions where I am holding house shares, so I recovered all my investments, my initial investment back, my cost basis, by shaving off some gains. They always say it doesn't hurt to take some gains off the table. The ultimate goal is for the whole portfolio to be house shares, so that you're playing with house money rather than your own money. But I haven't been investing long enough to really be at that point. And then finally, I will cut positions if my conviction is lost. I did cut 2 or 3 completely, but it was at the end of the year because I wanted to tax loss harvest on some of the gains I made for the year. We do need to measure ourselves. And the standard usually is the S&P 500 or the NASDAQ. So what did they do last year? So the QQQ did 19% in 2025, and the NASDAQ, and the S&P 500 did 16%, compared to the historical average of 10 to 11%. Any experts out there, please correct me in the comments below. I think I'm pretty close, but this is close enough for me. I'm no expert. I'm just an amateur at working, trying to understand and do this at home. So cut me some slack. So let's see how I compared to the S&P 500 and the QQQ. So normally, because I'm moderately aggressive, I should be comparing myself to the NASDAQ. My speculative bucket, this is the one that's pretty amazing to see. So when I'm counting these returns, calculating these returns, I take the beginning balance and the ending balance, and I remove any kind of added capital throughout the year. So if I deposited $5,000 into this account, I subtract that out. So this is purely only gains. I'm not including any kind of additional money that I inject into or deploy into the account. So just keep that in mind. These are purely on gains. I had a rate of return on investment of 90%. These are highly speculative investments, and I often sell those to get to house shares, and sometimes I'll just sell out completely. And mostly these are small cap stocks, for example, like Cydius and Rocket Lab and Nebius and A-Lab. Onda is another one, are all house shares. I sold, and now I'm just riding the rest of the shares to get to to see what they do, only because I believe that they still have a lot of room to run. But at least I've recovered my money back. So Rocket Lab, for example, in that bucket, I have 1,800% gains. So I started, keep in mind, I was buying this back in 2022, 2023, when it was a $4 or $5 stock. And it was hard to do. Trust me, this is not an easy thing to do. Buying stocks when nobody wants them, they think they're trash. So I'm buying things when I think they're dirt cheap and I see a future in them, and being part of an investment group also helps with that kind of psychology. Investing is really around psychology. So here's just some examples of those gains that I made. Rocket Lab is 1,800% gains in less than 2 years. A-Lab, Astera Labs, over 100% in gains. And I still think there's room to run on that one. Nebius, 266% gains in 1 year. Cydius, 350% in 2025. I was only buying that mid-year. I only had that for a couple months before it rocketed up. It was up at 500%, and now it's back down to 350% by the end of the year. Ondas, 275% gains. Again, most of these are all house shares. So let's move on to my main brokerage. This is my core long-term holdings. It's mostly taxable. It's mostly individual stocks. 25% of the stocks and 25% of this portfolio is ETFs and income stocks. So the ETF and income stocks definitely brought down my potential returns here. I have a few other positions that are house shares in this portfolio, namely Palantir. Palantir is at 200% returns, and Hims and Hers, for example, is at 600%. Several positions are between 250%, 200 and 500% returns, and I'm slowly selling those stocks to lock in gains and reposition into SCHD. So the overall portfolio performance for the year was 43%, and I will show you some of the stocks. So you can see this was my speculative bucket. This shows 114% for the past year, but that was by the second week of January. So really, it was only you can see the market dropped around here in November, December, and then started to climb back up. So it's not 114%; it was only 90%. So this is my taxable brokerage. You can see some of the percentage gains in some of these stocks. So Palantir, over 2,000% returns. I have my cost basis is $8.51. Now again, this was a stock I was buying when everybody hated it in 2020, 2020, 2021, 2022. Everybody hated it. So that's when I was buying it. Hims, I was buying it when everybody hated it. Shopify, 410%. MU, 340%. Right now it's over 400% return. And I only started buying that one in April at the April dip or the April crash with the tariffs. So you can see some of these are pretty spectacular. I mean, it shocks myself when I look at these. Going to my Roth account, I had a 93% return. So my Roth account, I don't have a snapshot of that, but my return on that was 93%. Again, most of these are buy and hold, like more matured growth. The Roth one really scared me back in 2020 because I made some huge mistakes on that. I had about 63% loss on that in 2022, and I'm telling you, it made me choke. That's one where I made a lot of mistakes, and I really regretted it. But it's since recovered, and thank God, and it's in a much better position than I ever would have imagined in such a short period of time, because I made some adjustments on those losses, and then over the last 2 years, it's more than 100% return. But right now, just in 2025 alone, was a 93% return. And I took some of those gains and put them into some safer positions within the account. So my IRA, I had 1 or 2 speculative stocks in this, but I really wanted to go safe on it to not make the same mistakes as before. So these are mostly ETFs. So you can see, and one big mature stock. So you can see Rocket Lab is really what topped it up. That was one little gamble I made with $1,000 within the account, and it's now it's over 2,000%. So that's a 1,900% in less than 2 years. But overall, the account has brought me. You can see it's almost 100% since I started it 2 years ago. So it's 100% return, but in 2025 it was a 68% return. This is a weighted average. So if you take all the gains and I took out all the beginning balances, again, removed any kind of money I injected into the year, any kind of new money, I removed that, and I took the ending balance. So my weighted average gain for the year was 50%. This is I'm astounded. In the investment group I belong to, there was a couple people, younger people, who weren't de-risking like I was. It was just bad timing. They did much better. I mean, some of them were 60-70% returns last year. I'll take it. Even with the de-risking I did, even with the income safer stocks that I put money into, I still did 50% in 2025, and I'm ecstatic about that. I don't expect that to happen before. Again, 2024 I even did better than this. 2024 my return for the year was 64%. Give or take a percentage or two. I didn't go into as much detail as I did this time, but I'll take this. And then you have crypto. So I have a small portion of this investment in crypto, and mostly Bitcoin and Ethereum. I invested in this for a few years during the pandemic era, but I stopped buying it 2-3 years ago. I don't understand it, and I think it's highly questionable if that's going to. I mean, there are a lot of institutions that have been buying into this, but I'm really questioning whether it's viable and what kind of purpose it's going to serve moving forward. 3 winners out of about 10 positions that I've had. I'm just holding what I have. It's less than 4% of my portfolio, and I'll just hold it to see what happens. It would hurt to lose it, but I'm not buying it anymore. So the last 2 years in the stock market have clearly been spectacular. Most of my portfolio is in tech, and I think I got into the first or second inning of the AI investments. Again, I'm not a trader, but I buy good companies at good prices, and then I monitor and hold. I also belong to 2 investment groups where we research stocks and sometimes piggyback off of each other's ideas and investments and research. And again, I stopped gambling. I gambled in 2020, but I don't do that anymore. I think it's too vulnerable. This video became a little long, so I'm going to break this up into two parts. The first part, which you just listened to, that covered the performance of 2025 and the returns, the structure, and how actually everything played out in my final year before early retirement. It was a very strong year, similar to 2023. I'm very happy about it. It was unusual, and the performance alone never tells a full story. In the second part of this video, I will talk about the lessons I learned, the mistakes I made, and the strategy, how my strategy will change going into 2026 and when I'm actually in early retirement. So I hope you really enjoyed this. Stay tuned for part 2. That will come out the following day, depending on when you watch it, or it might already be out. So part 2 will be coming up. Thanks again, everybody.